Okay, it's 11 o'clock. We should get going, I think. Busy morning this morning. So we've got Andrew McHattie, because he's going to be talking about what happened over the course of January, and obviously plenty was going on. And also we're going to be talking to Mark Boggett from Seraphim Space Investment Trust. Bits of news to run through first. There's actually loads of stuff this week I could have picked, but given we're busy, I just picked out two. So we're going to be talking about BBGI and the bid for that, and then the merger that was announced this morning between JP Morgan Global Growth and Income and Henderson International. So BBGI first, and you can see this is a very reliable trust. You've got 10 years worth of data there. The NAV just keeps going up, up, up. What went wrong was the share price, and it was trading on too big a premium. I mean, I think I was quite consistent in saying that before, but when interest rates started to rise and you had more options of what to do with your money, the yield available in BBGI didn't look quite so tasty, and so people started selling. And then that was compounded by the cost disclosure thing that meant that there were no buyers from the institutional side of things, which was daft, really, completely daft. And you can see the way the discount opened up. And then you can also see at the end of that chart there what happened the other day when the bid was announced. So the bidder is effectively Canadians, British Columbia Investment Management. They've created a bid code to do this. The bid is 147.5p, some of which is going to come via a dividend, and some of which is just going to be sort of like a cash payment. It's a decent premium to the closing price, but importantly, it's also a premium to NAV, and we'll come on to what NAV should be in a second. And this is not just a sort of, we'll take the assets and run away. They actually want to keep the management team and grow the portfolio. So basically, they're going to do what the market wasn't doing, which is that saying there's plenty of stuff to do in infrastructure. BBGI's got a good team to do it. We're going to back them with our money to do that. It's clear that the board was starting to despair about the discount, and there's a lot of stuff in the announcement that sort of says that was the reason that they felt they had to do something. They've recommended the bid, and they've already committed to vote their shares in favour. That's not an awful lot in the great scheme of things. So it's not beyond the bounds possibility that we'll get a counter bid, but given how generous the price is, I think it's unlikely. So the NAV then, now on first glance, it doesn't look very good. It looks as though the NAV has dropped 4.8p from the end of June, which, given how consistent the whole thing's been, would be one of the biggest falls in its history. So 3.3% is neither here nor there for most funds, but for this thing, it would have been quite a big thing. But I think basically the way that they're doing this, and I can't, I've emailed to clarify, I haven't had an answer yet. I think that NAV number that they're talking about doesn't include the dividend that's accrued and not been declared yet. So if you add back in 4.2p, then the NAV would only be down 0.6, and that really makes much more sense to me. So I don't think we are looking at sort of disaster at half 2, 2024. Now there is a wrinkle in all of this, and it also sort of really comes down to the fact that this is not a UK company. It's actually incorporated in Luxembourg. And because of that, it's not subject to the takeover code. And because it's not subject to the takeover code, normally what would happen in a bid is you put your offer up, shareholders will accept it. There might be a minority of investors that say, nah, we don't want to. But providing you go through a percentage, and I think it's 90%, you can compulsorily buy out those minorities under the takeover code. This one, you can't do that. And obviously, what they don't want to end up with is tiny holdings from other investors. So they're basically doing it so that you can just accept the offer and you'll get the cash. And that's going to be the quickest way to get your money. But if you don't accept the offer and they get control of it and they do what they want to do, they're going to sell the portfolio to the bidco. So all you'd be investing as minority investor is just a pool of cash, and delist it, so you won't be able to trade your shares. So basically, a big strong argument to accepting the offer. It would be daft not to accept the offer, is what I'm saying, unless you think there's going to be a huge wave of people that aren't going to do it. Because if you go down this route of not accepting the offer, you probably end up sitting around invested in a fund of cash, waiting for it to get around to liquidating. Everybody else will be paid out, and you'll be sitting there. And also, I think that might mean you'll have to pay liquidation expenses, so you might not get the whole cash offer price. So yeah, that would be a daft thing to do. So I think basically accept the cash offer. In terms of timing, we're going to get the thing published within a month. I think probably relatively soon. And there'll be a meeting to approve everything in the first quarter of this year, so by the end of March, and they'll be done and dusted. There is obviously a read across to everything else. Some things moved. The really surprising thing to me is that the renewables haven't really moved at all. I still think it's possible that one of those will be the next one taken out, but then of course it could be something else, the infrastructure sector, we never know. Now, talking of deals, we've now got another takeover by JP Morgan Global Income, and you can see why it's got the firepower to do this. It's a pretty good track record over the past 10 years. Obviously, you've got the COVID hit there, but neither here nor there. You've got a sort of stabilization of the NAV when the interest rates start to rise, and that hit growth stocks a bit. But it has its fair share of Magnificent Seven things, and that's helped drive the NAV up and up and up. And it's been beating its benchmark as well as all of the peer group. And so it's no wonder really that's trading asset value actually a small premium. So the contrast with Henderson International Income is quite stark. There the NAV has basically gone sideways for a very long time, and the discounts opened up. And I think, again, the board was slightly despairing of what was going to happen to it. It's also, well, it's decent-ish size. It's not enormous in the great scheme of things, and definitely it's about 10th the size of the Global Income Trust. And in terms of the performance record, you can see that quite starkly here. So it's a long way behind over every kind of time period that you can look at there. The only other interesting thing, I was flagged that, is how well that Invesco fund is doing. It was outperforming the JGGI, then it was underperforming, now it's outperforming again. Just one to keep an eye on. We'll see what happens to that. So yeah, natural partner for it really to go down this route. So in terms of the mechanics of it, it's the same scheme that they've used for all the other measures they've done, which is Section 110 Companies Act, whereby you effectively liquidate and all the assets into JGGI. The only difference is there's no cash option here. And the logic there is the JP Morgan Trust is already trading a premium. So you can roll into that and then sell those shares at a premium. And if that meant that pushed it onto a small discount, they would do buybacks. So basically, you're still going to get out an asset value, or maybe even more asset value. And because they don't have to go down this route of offering the cash exit thing, it makes the whole deal that much simpler. And that saves on all the costs, which is obviously good for everybody. Because a JP Morgan fund has got a tiered fee, and the top tier of the fee is 0.3%. More money flowing in drives down the overall ongoing charges ratio, and that comes down to about 0.42, they're saying. Maybe lower than that, we'll see how it goes. There's a small bit of long-term debt in HINT that it's going to take on. That's another here or there in the right scheme of things. One director is going to go across, which is quite a modest number, so that they weren't doing it to hold us their jobs. And JP Morgan will waive its fees for an amount equal to the cost of both sides, which I thought was a good thing. So, in terms of dividends, there is a small hit to your dividend income if you're a HINT shareholder, but it's not massive, and it's definitely not anything like the amount of uplift you get from the narrowing of the discount. So from that point of view, that's not a reason to say no. Those numbers there, that's my guesstimate based on the current NAVs, and there's a £1 million fee hit, which goes to Janus Henderson for losing their job. There's 6 months worth of fees, basically. It might be slightly less than that because they've probably given notice before the whole scheme takes effect, but we'll see how that works out. They say that there's quite a big overlap between the two sets of shareholders. I think that's a good thing. I don't think that the scale of the trust, because HINT's so much smaller, we're not likely to end up with a situation where people feel they have too much of JGGI and have to sell. So I don't think that creates an overhang, but so that is there. One probable seller, almost certain seller, is going to be Saba. So it took a stake in HINT in January, or probably in December and January, and then that's in January. So about 15 million quid's worth, maybe slightly more, 16. And it's almost certainly going to want to cash that in now. So that's a little win for it against an otherwise great sea of red. In terms of timing, we've got documents in April, May, meetings May, June, and everything wrapped up by the end of July. So that is enough from me. We're now going to bring in Andrew.
Great, thank you, James. And it's really interesting now that so many of our discussions and updates are all about takeovers and mergers, which just represents a completely different world from the one we inhabited 2 or 3 years ago, where those things were really unusual, weren't they? So they're very much at the forefront now. And the same is true, actually, if we look at the list of risers this month, which I compiled yesterday, which is why BBGI Global Infrastructure is not on the list. But actually at the very top there, you have Ground Rent Income Fund, which is a small, slightly esoteric fund, but it's actually received now 5 indicative bids, which have been slowly increasing up to now 40 pence per share. And it's rejected those, so it hasn't yet reached any agreement or resolution. But obviously the shares have come up in response. And I suspect that those shares will also be on the list of risers or fallers, I'm not sure which, next month too. So that's one still to be resolved. And we have our usual mix here of risers, actually a fairly decent bunch. One interesting one, the second one on the list, is Golden Prospect Precious Metals. I think with quite a lot of upset in a geopolitical sense, and of course we're waking up every morning to the latest announcements from President Trump. I think that has helped the gold price actually quite considerably, as some people have opted for a little bit of safety. So that's helped that trust, and those shares are up 20%. But I think the broader theme here, one which does stand out to me, is that there are actually 6 European trusts on this list. We can just highlight those. And actually those were up quite significantly over the month. And my sense is that this was a slightly hidden shift, actually. I'd noticed 1 or 2 going up, but I hadn't realized it was quite such a broad shift across the sector. There's some very nice gains, actually, across Europe. So I'll come on and talk about that in a moment. We'll have a look at the fallers over the month, which were, as usual, generally less dramatic, with the exception of the one at the top, Digital 9 Infrastructure, which has been at the top of that list a few times. Obviously, over the last month, it had the very disappointing sale of its Aqua Comms holding, which meant that the NAV came down, but actually it caused a great deal of pessimism about what was left in the portfolio. We've subsequently had another update, which was a slightly more reassuring one, where the NAV was recalculated, and actually it does indicate there's still a very big discount here, but a great deal of pessimism about exactly what value might be finally realized from the portfolio. So we'll have to see how that one plays out. Again, rather like Ground Rents Income, I think we'll be seeing Digital 9 Infrastructure on the list of movers for the next couple of months as well. So that's going to be interesting to see. Again, though, I think on this list, there's one theme that really does jump out to me, and that's not always the case, but it was last month. And that is that the renewable infrastructure sector really has suffered again. And it is interesting, actually, in the light of that news from BBGI, that this sector hasn't really jumped up in response. And in spite of the very interesting valuations and wide discounts that we're seeing. And you saw it was another very weak month with some double-digit declines here as the sector is out of favor. So I'll talk about that a little bit as well as we go on. Okay, so let's now move on to Europe, which to my mind was a slightly hidden rise actually that we had in January. And I think that's probably just because so much of our attention was focused on the US and the inevitable news flow that's coming out of that. But actually, across European markets, there were very, very good rises across the bourses here. You can see Germany was up 9.5%, same for Spain and other markets as well. The chart here is a one-year chart of the Euro Stoxx 50 index. And you can see that it's really had this significant bump on the right-hand side there as we enter 2025. And it's up 8.4% over the month, which is a very significant monthly increase. So let's have a look at why that might have happened. And I think certainly one of the key reasons for it happening is just that Europe is not the US, and that helps. So it's really away from this incredible noise we're having with President Trump, making a lot of pronouncements every day, talking about tariffs, and that's obviously impacting its immediate neighbors, but China as well. And Europe has so far been fairly exempt from this. If we could just move on to the next slide, please. There's a bit more detail on this. So I think we've seen a bit of rotation, actually, as people have come out of some US stocks that are very highly valued because they're a little bit more nervous about those now. And of course, the nerves about those were greatly increased by the news from DeepSeek, the new Chinese AI competitor, which I think did trouble the high valuations of the Magnificent Seven stocks. Certainly Nvidia came down very sharply briefly. And I think it's caused question marks about those, which again makes people think about having so much of their money concentrated in those stocks. So they're looking for alternatives. And I think Europe is a very reasonable alternative because it's really somewhat at the side of all of this news flow about tariffs at the present time. And I did read quite an amusing article about the mega effect making Europe great again just because it's not being targeted. But I do think actually there are several strands of news that are very gently moving in favor of European equities at the present time. And one of those is the potential for a settlement in Ukraine, which I think would be fantastic news generally, but also very helpful for European economies. They're still suffering somewhat from high energy prices, and I think quite a lot of overflow from that conflict. At the same time, we saw the ECB cut its interest rate very much as expected this week, down by 0.25%. Obviously, they came down in the UK as well. And also, I think there's a little bit more optimism creeping back. We saw the quite important Purchasing Managers Index just get back over the 50 mark, which means it's positive rather than negative. And so I think that's quite good news. So I think taken together, all of these factors combined means that the markets have been able to rally from actually a base of some pessimism. And that's why I think we've seen this start of year increase. There is one thing to watch out for, and I'm certainly no expert on German politics, but the election there is coming up on the 23rd. The polls at the moment are suggesting that the Conservatives are going to win, but there's likely to be some kind of coalition government, and we don't know yet quite what the makeup of that will be. So there is scope for a little bit of a surprise and an upset there, but I think at the moment the market is really not expecting any major worries over that. So things look pretty good in Europe now. And if we look at the investment trust and sector, these are ranked by the 1 month NAV return. What's interesting here is that there are two sections here. We have the mainstream European trusts that in the first section at the top, and then the smaller company trusts in the second section. And as it happens, they're ranked perfectly by NAV return because the larger ones have done better than the smaller companies, which is, of course, quite often what we see in the early part of any market rally. It's big companies that lead the way. And that's what we've been seeing here. And I think actually all of those major European trusts have been doing reasonably well. They're quite clustered. It's nice to see European Opportunities Trust on the list, actually, which was, of course, one of the first trusts that was targeted by Saba. And it managed to fend them off, although with a tender offer, and there's another tender offer coming. But nevertheless, it's certainly having a better time of it now. So broadly, I think these trusts are quite tightly clustered, and the same is true of their discounts, actually. There's nothing really outstanding there. The discounts in the sector are generally between about 6 and 13%, but there's still a bit of value here if you believe the rally might continue. All right, so on the downside now, renewable energy infrastructure, this is really such an out of favor sector. And I think quite often it's easy to blame gilt yields because that's an obvious comparator here. There's an argument that because you can obtain a better return from gilt yields, it's really not worth you taking on the extra risk of the infrastructure funds for a couple of extra percentage points on your dividend yield. And there has been actually a decent correlation between those two. But I think that's not the explanation for these falls over the last month. Because actually, since mid-January, gilt yields have been falling. Obviously, we've just seen the base rate come down from the Bank of England. And I think actually there's a little bit of a disconnect here, which implies that perhaps the renewable energy trusts are overdue for a bit of a rally. Certainly, the discounts and the yields look compelling. And I think maybe we haven't been focusing on these as much as we might otherwise have been doing because of all of the concentration of effort and views on Saba. And of course, their activity has been amongst the equity investment trusts. So we've been looking at the discounts across those. But they're much wider in the alternative sector and in the renewable energy space in particular. And I think you have to wonder after this news on BBGI, whether there are other buyers actually that might be having a look at these assets, because there are some very good underlying assets here and they're trading on discounts of 30 or 40%. So unlike the BBGI deal, where the price being paid is at a premium or very close to the net asset value, actually you would think a buyer in the renewable space could probably get away with paying a discount, which would still be a significant jump up in share price for beleaguered shareholders. So I do think some corporate action is possible here. And we'll have to see if that happens. I have no knowledge of it. But if you look at the next table, actually, of all of the discounts in the sector, there's some really compelling numbers here. This is ranked by the discount. So biggest discount at the top, Hydrogen One Capital Growth, and that has its own reasons for that, perhaps. But after that, you'll see the discounts are wide right across the sector, even from some very high quality trusts, I think. So the tightest one of all is Greencoat UK Wind, probably as we would expect, because I think that's considered really a blue chip in this group. But it's still a discount of 22%. And to my mind, you have other high quality trusts, such as Bluefield Solar Income. They're on a 35.8% discount, offering a yield of about 11%. And I think that's a terrific yield to get. And I think you can lock those in and be patient. We often say that with dividend yields, you can be paid to wait. And I think that's really the case here, that actually you can lock in some of these into your portfolio, pick up a yield of 10 or 11%, and then just wait and see if there is some activity in the sector and those discounts come in, because there really is a lot of value here. And I can't see it staying that way. I don't think if I put up this slide in a year's time, we'll see the same numbers. So there we are. With that bold assertion, I think I'll move on and hand back to you, James.
Thank you, Andrew. Yeah, I'd have to say I agree with all that. The discounts are just daft in the renewables at the moment. And actually, one of our viewers actually noted that rising door, and as I say, I think it's very much deserved. Anyway, let's move on and talk about space. So thank you very much, Mark, for coming and doing this. As usual, I'm going to hand over to you for a bit and let you tell us a bit about the fund, and then we'll have some questions from the viewers. So,
okay, great, thank you, James. Right. Well, you know, that last discussion about renewables is actually a good segue into what we're talking about here for space. An interesting year behind us last year. I'm proud to say that Seraphim Space Investment Trust was ranked number 3 out of 371 for its performance in the 12-month ending 31st of December. We were up 58% year on year. And we had some really interesting performance in the portfolio. We had, in relation to our listed portfolio, we got 4 stocks that are listed. We had 2 of the top 10 global performance in space tech companies. AST was second globally, increasing 384% in the last 12 months. Spire Global was 6 of the top 10, up 75%. And then our private portfolio had 2 of the top 10 companies globally that raised the most round of equity capital. Deorbit in 5th place, raising $166 million, and Iceye in 7th place, raising $158 million. So a huge amount of activity has been going on in the space sector last year. The poster child of the sector, SpaceX, its own valuation surged to an incredible $350 billion. The main piece of news, of course, that really is impacting everything is about the new president in the US. And this is especially relevant for the space sector because in his first term, Trump was really very focused on space. He was actually the president that led Artemis Accords. So this is the focus on taking man and woman back to the moon. So he initiated that, and that has now got tens of countries signed up working with the US on that goal. He was also the president that brought in the Space Force. So he initiated that. That's now being copied here in the UK and around the world as this domain really comes into focus. So all of this activity that's going on and the stats that you can see there on the screen, I think are not representative of the fact that we're currently sat on a 46% discount to our NAV, which we believe is something that will be addressed during the course of this year as this gets recognised by the market. So if we can just turn to the next slide. What I wanted to do today really was just dig a little bit more into the broader Seraphim organisation, so you can really help understand how we're best positioned to be able to continue to identify and invest and support the best businesses globally in the space market. Just starting off here with our global deal flow, we get to see an incredible 150 to 200 space investment opportunities every single month. And we've qualified that that's more than 75% of all of the space deals globally. And that puts us in a unique informational position to really understand what is going on with all of these companies, because these companies are private companies. This information is uniquely available to us, and we use that to make our investment decisions. The group has, the Seraphim Group has 3 parts to it: an accelerator program, which is the largest space accelerator in the world, just about to start its 15th cohort. We have a private venture fund element that invests in the earlier stage, higher risk parts of the space market globally. And then we then have the growth fund, the Seraphim Space Investment Trust, that invests in B stage and later. So this is part of the reason why we receive so many deals from around the world, is that we've got something to offer entrepreneurs and management teams raising money at every single stage. Next slide, please. So again, for those that are new to the space market, I just wanted to provide some more background. just to help you understand why this is
I've lost contact with Mark. Oh, let's see again. Let me get them back. Patience, please.
This is all driven by SpaceX and their incredible Falcon 9, which has really revolutionized the industry. To put that into perspective now, there was a launch last year every 34 hours. So it's not just about low cost, it's also just about access to space. And what that's leading to are constellations of much larger satellites. And this is really where we're very much focused on. These large constellations of hundreds or even thousands of satellites are now creating a digital infrastructure around the Earth that is providing new forms of communication, new forms of capability that we believe is going to drive trillions of dollars of value. But the point is that we're only at the beginning of this process. 18,000 satellites is the total amount of satellites ever launched in the history of space, and yet half of those were just in the last 4 years. So what we're seeing now is exponential growth in the number of satellites that are being launched, and this adds to this capability that we consider to be akin to the advent of a new internet. We believe it's got that kind of impact. If we could just move on to the next slide. And briefly, this is how we think about how the evolving opportunity in the space market is focused on for our investment activity. Our main focus is around today, Space 2.0, this digital infrastructure. We like to invest into vertically integrated satellite constellations, particularly those that develop their own satellite, build their own satellite, develop their own AI and ability to be able to analyze the data and have relationships with end customers. So examples are Iceye, our largest company, Hawkeye 360, Satellite View. So the majority of our portfolio are actually sat in this particular area. The next area is around the growth of infrastructure in space. And this is really being developed and accelerated, again, by SpaceX, that have got their new rocket launch, which is called Starship, that can now take 100 tons into space in a single launch. They haven't yet set the price for this commercially, but we believe it's going to halve the cost of sending a kilo into space. So this really heralds the new era of infrastructure in space. And we're already investing into this, and these companies will really benefit. In fact, some of our best performing companies are in this area. So this is things like data centers in space, cell towers in space, and the environmental approach to ensuring that space doesn't get too filled with debris is another area that we've been heavily invested into that have seen significant growth in the last 12 months. And then the area of space that we don't really invest into, but most people, when they think about a space fund, consider this is the area that we probably play the most. It's about the moon as a stepping stone for Mars. It's about all of the technology developments that are required for permanent habitation. It's about space travel. It's about resource utilization in space. We don't really invest into any of this area because there really isn't an end market. Really, governments are really the only market for that area at the moment. Whereas in Space 2.0 and Space 3.0, there's $1 trillion market opportunity. Every single industry is looking to find new ways to use new data sets. And right now, we're going through a period of growth, largely driven by organizations like Deloitte and KPMG and Accenture, who are going to each of their different underlying large customers and clients, and they're saying to them, what are you doing in space? Here are the 4 or 5 data sets and new forms of communication that you can leverage to reduce costs, to increase your profitability, to provide better services to customers. And here's how you integrate them into your day-to-day operational systems so that they can add that value. So that's only been going on during the last 12 months, but it's accelerating now, and it's going to have a big impact on the types of companies that we invest into. Next slide. So here is the portfolio, and the majority of the portfolio, 75%, is made up by these top 10 companies. So when we last reported, we demonstrated that these companies grew their revenues on average by 71%. This portfolio raised $900 million of equity funding in the last 12 months, and 60% of the companies are now profitable, or they've raised sufficient money to reach cash flow break even. So this is a group of companies that have rapidly grown and reached EBITDA positive in the last year or so, and all of the drivers are now in place to continue to accelerate that growth. Just going back to President Trump and what his position in office really means now, it's a key driver around defence, and he's calling upon all of the NATO members to increase their percentage of GDP from sub 2% to 6% is what he's looking for them to do. I don't think we're ever going to get there, but we're certainly going to get to the 2.5–3%. Significant amounts of budgets that are going to be allocated to defence, and space is very much at the tip of the spear for that defence spending. It's about digitized capability, about new forms of communication. It's exactly what is required for modern warfare. And we believe that our portfolio is very, very well positioned to benefit from that. It's part of the reason why they've raised so much money in the last 12 months. We're going to see that start coming through on much more increased revenues during the year ahead. So just looking at the top 10 here, just to sort of give you an indication of how defence is really driving these businesses. The defence is the number one revenue driver for Iceye, Deorbit, Allspace, Hawkeye 360, LeoLabs, Satellite View, Astroscale, Tomorrow.ai, and QuadSat. 9 of the top 10, their number one customer is a defence customer, and that whole entire industry has got more budget than we've ever seen before. And we believe that this is going to filter through to these portfolio companies in the year ahead. They're well resourced to deal with that extra interest from customers, and we believe that that is really going to see these companies take off. The other thing, of course, is that defence is a highly acquisitive area, and we believe it's likely that larger acquirers are going to start looking at these fast-growing companies within our portfolio, particularly those that have now become profitable, and that they will become targets for the year ahead. We've also got companies that are planning IPOs. One of our companies that's just below the top 10, Voyager, has recently announced that they are filed for an IPO. That's their space stations in space. We're excited about what that might lead to, but we expect to see more in the year ahead. So my final slide here is really just to sort of wrap up. And 2024 in review, the number of companies that were funded last year, 50% up on the year before. The amount of capital that has been privately invested globally into the domain, 25% up on the previous year, where we're seeing sort of the rest of the private market around venture and tech actually down. And then the geopolitical drivers are all in place for the year ahead. And we're expecting that to bring new investors into the market, increased investment from PE, sovereign wealth funds. So we believe that that will enable our companies to continue to access capital and continue to thrive in the year ahead. So hopefully that'll give you a new perspective on this fund, but hopefully also give you the perspective that a 45% discount to our NAV is something that doesn't seem warranted given the description I've just provided of where the portfolio is today.
Yeah, definitely all sounds quite exciting. Good. Something slightly was take it all back, like something more prosaic. So in terms of how you run the fund, you've got cash there on the balance sheet and no gearing. Is that a deliberate thing that you don't want to gear the portfolio? And what's the cash for? Is it to do follow-on investments or new investments or?
So gearing has become more challenging because of the high interest rates. It's something that we actively monitor, but we've decided not to implement just yet. It may be something that we choose to do as interest rates start to decline. It's certainly one of the tools in our box there. In terms of the cash that we have, our portfolio, 60% now profitable, have raised sufficient capital to reach profitability, but that leaves the other 40%. So we need to be able to continue to support those companies. We're a catalytic investor. When we participate in a round, it gives confidence and conviction to the other investors. So just for that reason alone, we need to be able to continue to support the portfolio. We are still selectively adding new names. Last year, we invested in a company called Skylo that is linking your mobile phone directly to geostationary satellites. So you're going to be able to make texts and calls from aeroplanes or from boats or the top of mountains during the course of this year. That company's growing very, very quickly. We've added another name to the portfolio at the end of the year that we've not yet disclosed, but I can say that it's a really exciting energy company that we believe is poised in a good position in a massive growth market. So yeah, we're just being very selective. The bar is very, very high, but we also have our listed portfolio that has performed well in the previous 12 months that we can draw upon for liquidity if we want to and need that for the portfolio for making new investments.
Okay, fair enough. Thank you. Those new investments, are they coming out of the venture portfolio, or are they things that you sort of found through doing that stuff?
So actually, the last two haven't. But as you can imagine, having a venture portfolio with a range of companies where we've really got to know the management team, really understand the risks associated with that business, really understand the competitive environment. When those funding rounds come up, those are ones that we carefully look at. But hopefully, it's a sort of good sign that the companies that we are choosing to invest in are not those that are in the portfolio. That we're choosing to identify others that we've just come across as fantastic new deals and great value opportunities to get into. So hopefully that should give investors confidence that we're not there just to invest in the portfolio with the private fund. That's definitely not the case.
Yeah, fair enough. There's a question here about SpaceX. So would you ever have bought it, I suppose, is probably the best.
So yes, I would have bought it all the way up to its current $350 billion valuation. Look, it's a fantastic company. It hasn't put a foot wrong. I truly believe with every bone in my body that it is going to reach a valuation of $1 trillion. I think it's well on the path to get there. And Elon, now with roles in US government clearing the way to make that happen, I think the risks against that have been reduced. So yeah, look, it's a fantastic company. We're not saying that we wouldn't add it to the portfolio. We are really looking to find the next SpaceX's. That's what we set out to do. That was our thesis. So if SpaceX is worth $350 billion today, what are the next best space companies worth? Well, I can tell you the answer to that. The next most valuable space company in the last year has been AST SpaceMobile, one of our portfolio companies that we invested in. Well, it was a private company, very early stage. We identified that company, we followed it through. It's now grown to become the second most valuable space company in the world. We, again, truly believe that there are going to be many space businesses valued between 10 and 50 billion over the next 5 years. And we believe that we're already invested into many of those companies that are actually going to be those businesses that are going to reach that kind of scale. And it's largely driven by defense in the first instance, because these budgets are here today. So these companies that are dual use, very few of the companies, in fact, only one company in our top 10 has established themselves as a defense focused company. The rest of them are commercial companies looking to serve the insurance market, the logistics market, the oil and gas market. They've just turned to focus on defense because there's just so much demand there. So our top portfolio companies today, or those that are sort of now reached EBITDA positive, have revenues from about 50 up to about $250 million. We believe over the short few years ahead that those revenues are going to reach into billions.
Great, thank you. Sticking with SpaceX for a minute, so obviously a big chunk of the value of that is Starlink.
Yes.
Is Starlink, is that a sort of a one-horse race that only there's only one winner in that Because I think the question here is about Eutelsat and SES.
Yeah. So both of which are shareholders and backers of Seraphim. So very recently there's been an announcement by the European Space Agency and the EU Commission that they've committed 11 billion euros to build out a equivalent to Starlink. They're likely to use the Eutelsat's OneWeb as an initial base, and then build upon that. You've then got, on top of that, you've then got Amazon with their Project Kuiper. So that's been talked about for a long, long time. Again, they're looking to put up thousands of satellites to rival SpaceX. They've just started to launch that. They, like SpaceX, they have their own launch capability, which is called Blue Origin. In fact, they've just, in the last month, launched successfully their first commercial rocket. They've now got certification to do that. So they're positioned the same as SpaceX to rapidly put up that constellation. And then there's a myriad of other commercial operators looking to do the same thing. So there is going to be a mesh network of new telco capability that's really going to really drive telecommunications market. It's really going to change the mobile network operators market. We think it's highly disruptive to that particular industry, and that's only now just being recognized by those players in those markets, with the likes of AT&T and Verizon and T-Mobile now, rapidly scrambling to get involved with some of the leading companies within this new space market, including our portfolio companies. We've just had $400 million invested into AST, 3 times oversubscribed, and again, those are the types of names that are involved with backing this company.
And then, obviously, the government plays a big role in this sector.
Yes.
There's questions here too about is this a space race between the US and other major powers, and also, are you interested at all in what's going on in places like India?
So yes, so it is a space race. The space race is largely between US and China. In terms of space-based capability, they're about neck and neck. So that's really worrying to the Trump team and the overall sort of defense community in space. So this is why they're doubling down. But they're recognizing that it's small, innovative companies that have got this technology that they need to give them that technology advantage. So the US is literally doubling down in order to be able to do that. The statistics in 2024 were worrying for the US. In the first half of the year, for the first time ever, there was more investment privately in the space market from Asia than there was in the US. By the time that we got to Q3 and Q4, that had normalized, but it's just sort of representative of this race that's going on. And then you've got Europe not wanting to be left behind. And, an example is that $10 billion that they've just committed. So Europe has got a rapidly growing space industry. And then in relation to India, it's one of the most exciting markets out there. They're really well positioned to sort of pick up where China is losing. And space is a huge part of their heritage. They've already got a giant space industry. They've got their own launch capability. They've got a community of well-qualified pool of talent. So there is a burgeoning group of companies that are emerging there. We've already made our first investment into one through SSIT called Pixxell, and that we did that in their seed round, and they're now recognized as one of the top 3 Indian space companies. So again, just more evidence that we can spot these companies early through our information asymmetry, and then continue to back them through that next scale. So I would be watching this space because it's highly likely we're going to be adding more Indian companies into the portfolio in the years ahead.
Okay, thank you. Just taking the portfolio, a couple of questions on specific stocks. So can you tell us a bit more about LeoLabs, please?
Yes. So LeoLabs is a ground-based radar that what they do is they look up into space and they're able to identify an object the size of a 2-pence piece from 1,000 kilometers away. They're then able to track that in real time as it races around our planet at 17,000 miles per hour. And that 2 pence piece is equivalent to a piece of debris. And as it gets larger, satellites. So effectively what they're doing, they've got 9 ground-based radars around the world. And what that effectively provides is vision and visibility to debris and satellites in space. So they now count more than 75% of all of the operators in low Earth orbit as their customers. They're the market leader. And effectively what they provide is a Google map of space, where everything is. So this is the reason why all the operators have to use them. They are the de facto data set. It's also a requirement now for the regulators to use them, because previously they couldn't even see the assets that they were regulating and that they are ultimately responsible for. That's rapidly led. So in the last 12 months alone, we've seen the first ever fine that's been given to a satellite operator for not moving their satellite out of orbit within the time frame that regulator had allowed. So we're going to see more of that. And then the other participant there is the insurance companies. And again, they're able to see the assets that they've got insured. They're able to monitor how the operator behaves and how much they take care to move those satellites out of the way of any oncoming danger. And then that will have an impact on their future premiums that they pay. So this is a massive multi-billion-dollar growth market, and LeoLabs is very much at the forefront of that, growing very quickly.
Correct me if I'm wrong. Wasn't part of its role going to be be moving those satellites around?
Correct. Yes. So D-Orbit is today more of a sort of launch company. They are a rocket that goes inside a SpaceX, and they then sell space on their rocket to 10 to 12 other satellite operators. SpaceX then launches its rocket and drops all of its passengers off at the bus station. Everyone gets off at the same spot. They then start their engines of their own rocket. They then go and deliver the satellite customers to where they want to go in their particular orbital slots. And then they've got an empty vehicle. So that's when they developed the second phase of their business model. And this was the reason why we actually invested into this company, is because those empty vehicles then become white vans, AA and RAC vans, parked in space, waiting for a customer to ask them to come along and to remove a broken satellite, to tow a working satellite into position, to swap them over, and then to take that broken satellite and push it towards Earth's atmosphere, where it then burns up and doesn't create the debris that is the thing that the regulators are now trying to address. So they've got a really interesting business model and are growing very, very quickly as a consequence of this unique position they've got.
Great, thank you. Last one on the portfolio, QuadSat. Can you tell us a bit about that, please?
Yeah. So this is another unique business. They use drones to emulate the activity of a satellite for testing ground-based antennas. So let me give you an example of why this is sort of important. So on top of any ship, there's these large domes. Each of ships have at least 2, often more, and within those domes there is a satellite dish that moves to face towards the satellites. And what ships actually do in order to test that these are working properly is that they go into open water and they then move the ship in different directions to make sure that this is calibrated and working correctly with the satellites. What QuadSat do is they effectively use drones to emulate the satellites so that you don't need to move the actual vehicle in order to be able to do that. So that effectively reduces the cost, speeds up the time, and means that you can have your antennas better calibrated at all times. So that's the largest aspect, but it's also used for fields of satellite dishes to make sure that they're calibrated. So again, this is a multi-billion-dollar service industry that's currently done manually, and effectively what QuadSat have done is that they've automated that process. They've reduced the cost by an order of magnitude, and then they've automated the process. So they're going after that services market by providing an automated solution. They've got many big customers in this market now. In fact, virtually all of the big players are signed up as customers, and they're now then going through that period where that is then started to be reflected through in revenues.
Brilliant, thank you. And then in terms of sort of the big picture of why you want to buy the trust, is the argument that these things at some point will be IPO'd and then you'll crystallize the gains that way, or is this a long-term investment in the future of these companies?
Yeah, so this is a long-term investment in the future of these companies. They are going to IPO. We've got 4 companies that are planning to IPO at the moment. They will get bought, but they are going to grow. So take Iceye as a good example. You know, a couple of $100 million in revenues at the moment, and it's largely because they're focused on a single customer, which is defence. We expect those revenues to grow very quickly just through that customer, and that customer is like, you know, the DoD, UK, and other defence organisations around the world. But the real big opportunity here is about using their data in commercial markets, and you know, where GPS is the blue dot in your mobile phone, these guys are effectively the green dot in your mobile phone. Hundreds of pieces of information about that green dot in close to real time. So that is ultimately going to be used by every industry you can think of over a period of time. Their sales teams currently, because of the huge demand from defence, are not set up to focus on those markets at the moment. And in due course that they will do. So, you know, I made the point earlier that the revenues here, and this company's now profitable, but the revenues are going to grow from hundreds of millions to billions. The enterprise value will grow from, you know, billion into tens of billions. And this is just a great example, really, and reflective of the rest of the portfolio of what we expect to see over time. And that really is from the digital infrastructure businesses that we've invested into. Then we've also got the infrastructure businesses that we're invested into. And again, you know, we see them becoming, you know, really important parts of the infrastructure that runs society. You know, remote cell towers, data centers. You know, these are huge markets that they're entering into. The other big one that we haven't talked about today, although I briefly referenced through the IPO of Voyager, one of the big markets that we believe is going to be a driver for growth in the years ahead is around manufacturing of drugs in the zero gravity environment of space. Every protein, every molecule behaves differently in that environment. We're now just gearing up to manufacturing of drugs in that environment, and we believe that there's going to lead to, you know, lots of cures that have never been obtained before, but they'll be manufactured in that environment. The companies already exist. We've already invested into them, and now they're just starting the early stages of building that out. So what this portfolio represents is the sort of here and now of space, and the next phase of space, which will give us a 10 or 20-year growth. We haven't yet started playing with stuff that relates to the moon and Mars and space travel and all of those things, because there's just so much going on the space to Earth market that we just don't need to at this time. So yeah, I think this is a great long-term investment. You know, if you're thinking about putting money away for grandchildren, children, all of these sorts of things, I think the long-term growth in this fund is just baked in. And the huge discount that we sit on at the moment is preposterous, given the position of the portfolio, the position of the market, our leadership globally in this domain.
But I mean, I'm assuming that if investors can latch on to like an obvious win, then that will help get it re-weighted. So yeah, we'll see what happens. Good. Thank you very much for all of that. Can we just ask, because there's a question here, do you have stock in the trust?
Yes. So all of the senior team do, I believe.
Cool. Well, I think on that note, we should probably call it a day. But thank you very much for your time this morning.
Well, thank you for inviting me on.
Really interesting, and good luck with it all. And we'll get you back again soon. But we'll be back next week talking to the manager of a Shaker Whiteoak Emerging Markets Trust. So in the meantime, have a good weekend, and we'll see you next Friday. Thank you.